Have you ever dreamed about owning a piece of a skyscraper, a shopping mall, or even a luxury hotel, but just found it way too expensive? Well, what if I told you there's a pathway you could own a slice of these high-value properties without breaking the bank? Today, we're diving into the world of REIT investing. Real estate investment trusts, or REITs, have been around since the 1960s. What are REITs? How do they work? And how can they fit into your investment strategy? Grab a cup of coffee and stay with us until the end, because you don't want to miss this. Remember, knowledge is power, and in this case, potential profit. So, REITs are essentially companies that own and operate or finance income-producing real estate. Imagine a bundle of different properties, all wrapped up in a neat package. That's a REIT. It's like a mutual fund, but instead of stocks, you have properties. And just like a chocolate box, you never know what you're going to get. Some REITs invest in shopping malls, others in office buildings or apartments. Some even invest in storage facilities. We all know how popular those are, right? Talk about finding treasure in someone's old junk. Now, why should you consider REITs? Well, two words: diversification and dividends. REITs allow you to spread your investment across different types of real estate, and because they're required to distribute at least 90% of their taxable income to shareholders, they can be a fantastic source of regular income. By now, you might be thinking, hey, this REIT thing sounds pretty cool. So here's a question for you. If you had the choice, what type of property would you invest in through a REIT and why? Let us know in the comments. While at it, don't forget to check out the description box below for valuable resources. But wait, are there risks? Of course, as with any investment, REITs have their risks too. Real estate market fluctuations, changes in interest rates, and management quality all play a crucial role in the performance of REITs. Remember, it's always wise to do your homework before diving in. It's a bit like going on a blind date set up by your best friend. They've given you a brief, but you'll never really know what you're getting into until you've done some Facebook stalking, right? If you're finding this information valuable, if it's shedding light on the mysterious world of REITs for you, then be a favor and like, share, subscribe, and hit the notification bell to stay updated on all our future videos. Let's not stop there. I think it's time we pulled back the curtain and examined REITs a little more closely. There are primarily three types of REITs: equity, mortgage, and hybrid. Equity REITs are the most common type. They own and manage income-generating properties, and your earnings come from the rents they collect. Imagine it like being a landlord, but without the hassle of chasing down rent or fixing leaking faucets. Mortgage REITs, or REITs, don't deal with properties directly. Instead, they provide loans to real estate owners or invest in existing mortgages or mortgage-backed securities. It's like being a bank, without the need to handle all those pesky customer complaints. Hybrid REITs are a combination of both equity and mortgage REITs. They own properties and have investments in mortgages, offering a mix of income from rents and interest. It's like getting the best of both worlds. Each type of REIT comes with its own set of advantages and risks. Equity REITs can provide stable income through rents, but property values can fluctuate due to various factors like economic downturns or even changes in the neighborhood. Mortgage REITs can offer higher yields, especially when interest rates are low, but beware, they're also more sensitive to interest rate fluctuations. When rates go up, their profits can take a hit. Hybrid REITs can offer a balance between stable rental income and the potentially higher yields of REITs, but they also inherit the risks of both equity and mortgage REITs. It's like eating a mixed bag of jelly beans. Some flavors you'll love, some not so much. You might be asking, how can I start investing in REITs? Well, it's simpler than you might think. You can buy shares of a REIT directly on an open exchange, just like you would a stock. Some REITs are also available through a mutual fund or an exchange-traded fund. The key to investing is research. Like a surfer watching the waves, you need to understand the patterns before you ride. Study the REIT's financial health, the properties they own, their management team, their dividend history, and market conditions. This will help you make an informed decision. But be careful. High dividend yields can be tempting, but they might also indicate the REIT is not performing well and is returning more money to keep investors happy. Don't let the sirens lure you onto the rocks. Now, before I let you go, here's a bonus fact for you. Did you know that investing in REITs also comes with certain tax advantages? Because of their unique structure, REITs avoid corporate income tax as long as they adhere to certain rules. However, the dividends you receive are usually taxable. It's like the government is your silent partner in this investment. Take your time, keep learning, and always stay invested in your knowledge.